Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 105, titled The Poor Man's Covered Call, Rolling Options in the Current Contract Month. And we'll be using the BCI Poor Man's Covered Call Calculator to detail how to manage our trades. Now, as most of you know, one of the critical aspects of successful option trading is position management or exit strategies. That is the third of the three required skills after stock selection and option selection. In this podcast, we're going to detail rolling options in the current contract month. Let's get started by first defining what is the poor man's covered call. Well, this is a covered call writing like strategy. So it's not exactly the same as traditional covered call writing, because instead of first buying a stock, we're going to be purchasing a deep in the money call leaps option as a surrogate for the stock. Since options cost less than stocks, our investments will be lower, and therefore the return on our capital will be much greater. Now, there are pros and cons to this strategy, and those are detailed in my book, Covered Call Writing Alternative Strategies, and in our online video for the poor man's covered call. But suffice it to say that the main advantage of the poor man's covered call is that there's less cash required to enter our covered call trades. Now, a technical term for the poor man's covered call is a long call diagonal debit spread. We're going to call it the poor man's covered call. Now, rolling options in the current contract month for the poor man's covered call consists of both rolling up, and that's where we close the current short call and sell another at a higher strike price with the same expiration date. So that happens when the price of the underlying security goes higher. If it goes lower, then one of the strategies available to us is rolling down. And that's where we close the current short call and sell another at a lower strike, also in the same expiration date. Now, for traditional covered call writing, rolling down is always one of our choices as far as exit strategies are concerned. But we rarely will roll up in the same contract month for traditional covered call writing. So why do we consider that for the poor man's covered call? And the answer is simple. When we enter a poor man's covered call trade, in essence, we are taking on a long-term obligation. This is generally speaking how we do the poor man's covered call. We select an underlying security that we have a lot of confidence in over the long haul, because the deep in the money leaps option has an expiration anywhere from 1 to 2 years out on average. Therefore, by definition, we're undertaking a long-term obligation. Now, true, we can always close our position, but generally speaking, we're thinking in longer terms. And that's why we would consider rolling up in the same contract month for the poor man's covered call, but not for traditional covered call writing. Now, let's set up a hypothetical example of how this works. We'll bring in the BCI PMCC Calculator to show you how these calculations play out. Now, let's say on 5/18/2020, BCI was trading at 58.30. And let's say we bought one January 21st, 2022, so about a year and a half out, 35 deep in the money leaps option. And let's say the cost of that leaps option was 25.55. Now keep that number in mind, 25.55, when we do our initial trade structuring. So now we have the right, but not the obligation, to buy BCI at the strike price of 35, that deep in the money call strike price. Now we also then sell the June 19th, 2020, so 1 month out, $60, slightly out of the money call for $1.75. So that's the trade setup. Now what we do is we feed that information into the PMCC calculator, And for those of you also watching this podcast, you could see a screenshot of it now. For those of you not, let me explain what we see. We put in that information. The stock is trading at 58.30. We purchased the 35 deep in the money leaps for 25.55. And we then sell the $60 out of the money call, short call for 1 month out for $1.75. So that information is placed in the white cells at the top of the spreadsheet. Now the calculations will then become automatic. And it shows that our initial trade meets our system requirement for a credit of $1.20 per share. Those of you watching this podcast, it's the second green row, $1.20. What that means is if you take the difference between the two strikes, 60 minus 35, those are the two strike prices, and in the initial short call premium of $1.75, that's higher than the cost of the leaps by $1.20. We always want to see a positive number there so that if we're forced to close our trade, should the price of BCI go to the moon, we will always close it at a profit. That is the initial structuring required formula. And in this case, the formula is met with a credit of $1.20 per share. Now, this represents an initial time value return of 6.85%. This is what the spreadsheet shows us. Now, if BCI goes from current market value of 58.30 up to the 60 strike, that would result in an additional profit during that 1 month of 6.65% for a total 1 month potential return of 13.5%. So you could see the advantage of the poor man's covered call strategy, that the returns are much, much higher than traditional covered call writing because the cost basis or the denominator in our calculations is much lower. Keep in mind, there are pros and cons to this strategy. So don't just jump on board automatically because the returns initially are much higher. You have to understand all the working parts, and there are plenty of them in the PMCC strategy. Let's move on. Now we're going to take a look in another tab of the Poor Man's Covered Call Calculator. If the price declines from the initial price of 58.30 down to 52, or if it accelerates up to the 62 price. So we're going to look at both in the rolling in the same contract month tab on the BCI PMCC calculator. And the following results will appear. If we roll down to the 54 strike, which is now out of the money if the current market value is 52, we will get a net option credit of 1.89%. All right, so the stock price went down, and by rolling down, we will generate an additional time value profit of 1.89%. We're mitigating losses here. Now, if the price of the stock goes up to 64 and we roll up to the if it goes up to 62, and we roll up to the 64 strike, we will have a net option credit of $1.05 of 1.05%, as shown by the PMCC calculator. So rolling down generated additional option premium to the extent of 1.89%, rolling up to 1.05%, and you'll note that both strikes were out of the money in relationship to where the current market value at the time we use this rolling procedure. So when we roll the option, we should always roll to an out of the money strike, whether we're rolling up or rolling down. And you could see the benefit of the 1.89% in one case and 1.05% in another. Let's summarize. After entering a poor man's covered call trade that meets our required system formula, we immediately go into position management mode. Rolling option opportunities in the current contract month may present themselves, and if that's the case, we must be prepared. So if we make additional money by rolling an option, that's not luck. It's the intersection of preparation and opportunity. And using the BCI Poor Man's Covered Call Calculator will help guide us to make the best trading decisions, whether we're mitigating losses or enhancing gains. Before I go, ladies and gentlemen, as always, I want to mention our pride and joy, our best and most comprehensive investment package, the BCI Package, which contains 6 online video courses, including the Poor Man's Covered Call, 6 calculators, including the Poor Man's Covered Call calculator, and 5 books, best-selling books, an ebook format, which also includes Covered Call Writing Alternative Strategies, which has a large section on the Poor Man's Covered Call. The package also includes our ongoing and never-ending video training program of a library of Ask Alan videos, Blue Hour webinars, and we add 1 additional training video each month. Some months we add 2. The location of the package for more information is on all of our web pages. Just look for the link that says BCI Package. Ladies and gentlemen, I want to thank you very much for taking the time to watch and listen to this BCI podcast number 105, The Poor Man's Covered Call, Rolling Options in the Current Contract Month. Ladies and gentlemen, I hope you enjoyed this presentation, but more importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.